Millions of trades execute in a standard 6-hour market session. For an analyst trying to read uncompressed, raw tick data, this volume of information is blinding. It is statistical noise. To find any actionable signal, we have to compress this massive dataset into a readable mathematical model of market sentiment. We are going to deconstruct the core axioms of market analysis and build a visual framework for the crowd's behavior from the ground up. That final objective is the Japanese candlestick, a geometric structure designed to condense hours of trading activity into a single point. This discipline is about organizing visual information so the human eye can detect repeatable patterns within the market's noise. The bedrock axiom of technical analysis is simple: markets discount everything instantly. All known and unknown information, whether that is a global shift in crop yields or a secret illegal insider trade, is automatically synthesized and reflected in the current asset price. This creates a strict philosophical divide. Fundamental analysis asks why an asset has value. Technical analysis asks how the crowd is currently valuing it. Imagine arriving at a foreign street food market with zero knowledge of the local language or the ingredients being used. A fundamental approach requires exhaustively testing every single vendor's ingredients. That method is highly accurate, but it scales poorly when you have hundreds of options and limited time. A technical approach skips the individual testing. You simply look for the vendor with the largest crowd, assuming the collective has already done the research and determined the quality. This logic applies directly to any asset with time series data. Whether you are tracking equities, fixed income, or commodities, the methodology remains the exact same. Technical analysts ignore underlying fundamentals because tracking the momentum of the crowd provides a more efficient heuristic for short-term opportunities. To track this crowd effectively, we need a standardized summary of the day's trading action. If you look at this daily trade pattern chart, plotting every single trade executed during a session leaves you with a cluttered, unreadable scatterplot of noise. As shown in this annotated chart, we compress the noise by isolating 4 data vectors. The open serves as the baseline. The high marks the absolute maximum threshold. The low establishes the floor. The close represents the final price, establishing the reference point for tomorrow. This OHLC framework successfully cages thousands of chaotic human decisions into 4 precise, actionable mathematical coordinates. Historically, the simplest way to visualize this data was the line chart, which strips away everything except the closing prices. While it shows macro trends clearly, a line chart completely erases intraday volatility and critical risk variables. The next evolutionary step was the bar chart, which incorporates all 4 OHLC variables into a single vertical structure. The left and right ticks denote the open and close, while the central spine measures the total price range. But as the dataset grows, the bar chart becomes an issue. Analyzing months of data causes these tiny horizontal ticks to blur together, exhausting cognitive processing. High-frequency traders required an interface with superior visual contrast to parse market sentiment instantly. The charting method most traders use today originated with 18th century Japanese rice merchants, the candlestick. A candlestick relies on the exact same underlying OHLC data as the bar chart, but it alters the spatial geometry to make the information immediately legible. The solid, real body visually anchors the battle between open and close. Thin, extending shadows permanently record extreme intraday highs and lows. The critical advantage is color, communicating momentum instantly. One color if higher, another if lower. Furthermore, the actual size of that real body immediately communicates the intensity of the buying or selling pressure during that session. The candlestick marries raw data compression with human visual psychology, allowing traders to process massive amounts of information at a glance. However, understanding chart geometry is not a guarantee of windfall profits. Technical analysis is best deployed to identify high-frequency, short-term trades for small, consistent gains. While fundamental analysis remains effective for identifying long-term investments, technical analysis acts as the scalpel, used to calibrate precise entry and exit points. For any technical trader, the paramount rule is maintaining a rigid calibration of risk, which means ruthlessly cutting losses the moment the chart invalidates your thesis. Technical analysis does not predict the future. It provides a disciplined, visually optimized framework to navigate the unpredictable chaos of the crowd.